Report, Rick Helps Real Estate Show, whereas like Sean says, try to make sense of this crazy Arizona real estate market. Welcome everybody. That's a longer intro. I've been doing 15 seconds, but we're trying to go a little bit longer to give people time to come on. And we welcome Pat.
Rick. Buddy.
Oh, Pat loves the intro. That's what I was waiting for. Pat said we needed a longer Tyler said we needed a longer intro. So I baked it last night. So now we had fun, folks. We got to meet up with Tyler yesterday, and God, what a blast. Tyler,
you're
a great guy. And it's so fun. You guys, you see what we look like, but you're only a little tiny thumbnail. So we think we know, what you look like and who you are. So it's really nice to meet in person. And we hung out for almost 2 hours at Starbucks and just had a blast. So we need to start doing more of that. So
very intelligent guy, very knowledgeable, and he gave us a lot of kudos, which makes us feel good and appreciate that. But
fun stuff. So
yeah.
So anyway, the market. I got a couple numbers. That's all you need. And Keenan, yeah, that's all I need is your little thumbnail, right? So thanks again, Tyler. It was fun. Here, look at this, Pat. There's only one city where the number's going the other way. It's Paradise Valley. They're still slightly in a seller's market, but they went down another 7%. But everybody else is flying through the roof, with the exception of the outlying areas where there's a lot of new builds going on, Queen Creek, Maricopa, and Buckeye. But look at Chandler, 231. I mean, just about everybody's in a seller's market until you get down to Queen Creek. And not to read this whole thing, but it said, it's clear that in contrast to the COVID years, more remote locations are easier to buy than more central ones. Competition among buyers is getting stiff in the most affordable central locations, and supply is quickly dropping to extremely low levels. Upward pressure on pricing continues to build. Bargains are getting harder to find and are mostly confined to the outer areas such as Casa Grande, Buckeye, and Santan Valley. The general public appears to underestimate how quickly the housing market is recovering from the brief correction of 2022. Buyers need to come to terms with this or be left in the dust. And I alluded about this in a couple of videos this week, saying what you're seeing on the news is January data. January was contracts that were written in December, and there weren't multiple people going to look at the same house. That party's over. That's in the rear view mirror now. And so, how aggressive it's going to get depends on a lot of different factors, but as we're seeing things right now, it doesn't look like it's, going to turn around and prices start going down, especially when I look at, I apologize, I didn't put my ticker up there. Let me put this up here. There we go. So we have in the 7-day moving average, we kind of went up just a hair. Well, actually we didn't budge much, to be honest with you. But we're coming into Easter weekend. So these numbers are not going to mean anything for a couple of days. So I'm not going to dwell on that, but here's what's interesting. This article, and I showed this to you already, but housing market corrections losing steam. This is by Fortune, where 7 revised forecast models see U.S. home prices going from here. So there's always the forecasters and prognosticators out there. And here they come, folks. They've revised them. So they're saying we're passing through a home price correction. And this looks like a really daunting chart, but this is showing you the home price decline on a percentage basis and nationally. And it's now coming, it's up here. So I'll put the little red line there. So we're up here. We're climbing, going this way. So the article says, here come the revisions. CoreLogic says we're going to rise 3%. And Zillow says we're going to rise 1%. Mortgage Banker Association falling 0.16 and another 1.4 dip 2024. Goldman Sachs, we're going to drop 2.6 in 2023. Fannie Mae, 4.2. Let's
drop
see.
4.2 or go up 4.2?
What's that?
drop 4.2 or go up to
fall 4.2. Moody's Analytics fall 4.2. KPMG fall 8%. So, who do you go with? And Robert Schiller said why U.S. homebuyers should delay purchases. At least wait 6 months, he says. So that's as clear as mud, right? So.
Yeah. I mean, down 0.1, up, down 0.3, down 2.6, down 4.2. I mean,
up 8, down 6. Hike. Keenan, send us the link when you get it. Who are you listing
yeah.
it with? Stephanie, unemployment numbers released today were in line with expectations, except for some sectors. Otherwise, good for interest rate stability. Maybe only one more basis point hike in May, if that, right? So it's the predictability game. That's why I stay out of it. I mean, these guys, they don't get it right. Question for Pat. I know rates loosely follow the 10-year, but the 10-year is lower than it was February 1, but rates aren't quite as low as they were for February 1. Any thoughts?
It has to do a lot with, the 10-year fall, mortgage-backed securities. There's sometimes a disconnect between the mortgage-backed security and treasury market because when you get volatility, it does go kind of in line, but make a short answer. The lenders when there's volatility, lenders don't, give back that pricing as quick. Does that make sense? When it's volatile, lenders don't like to be caught with their pants down. Like you said, we've risen from March 8th. The 10-year was 98.97, and the high recently was 101. So we've gained. Let's see, 99. Gain about 2.5 points from the high. On the mortgage back. I'm basically on the treasury. The pricing, but that's really the answer. That hopefully answers it because, like you said, there's sometimes disconnect when you got volatility.
Well, I kind of equate it to food. When a ingredient, in let's say sugar, goes way up, sodas have to increase the price. When sugar starts coming back down, it takes them a long time to lower the price. They just
when the lenders get burned, they don't give back their pricing back right away. So you're going to see some, because I've seen rates, the treasury fall. Lenders will give back their pricing, but they're like, when it's on a volatile market, when we see 4, 5, 6 rate changes in a given day, lenders they're like, I'm just done pricing. Almost they throw up their hands.
Sean's asking you where you think rates are going to go. Are they going to hike them in May?
I gave Jerry a call today, but he didn't call me back.
he's
Jerome was
talk to the man.
I think my take on it is they are still incessantly just incessed with inflation, and it's still there. And I think they are pricing in another quarter, but then they'll just let it ride for a while. Now that would be my prediction. But the market.
Jimmy says the market's going to crash hard. Tell us why, Jim.
Yeah, it's all supply and demand.
Yeah, because Jimmy, for us to crash, this is going to have to turn around. Our listings are going to have to go the other way, and they're going down. But speaking of rates, Pat, the markets were closed today, and
they're closed. They closed early. The stock market was closed, but the bond market was open a half a day. So that's why we kind of saw the BLS numbers came out. They reported obviously there was like 236,000 jobs that were created in May. I guess the estimates were like 240. But Barry, we saw that the 5.5-year coupon, 30-year coupon down 48 basis points. They've been following the 5.5 coupon. There's different coupons. When rates start going down, they'll go into the 5s, and then if we have rates going lower, they'll go 4.5. Because like back when rates started going up, they were following the 2.5, and they went to the 3, and then they went to the 3.5, then the 4. So I mean, the U.S. Treasury was up 11 basis points today. I mean, you see this red right here. The reaction today was obviously negative in the bond market. Rates kind of went up. The cost kind of went up a little bit today. But I think that was mainly when you have a holiday like a Good Friday, the traders are getting out early. The markets are closing early, and they're closing out their positions, and they don't want to be open. So they're clear. I mean, you're going to see volatility on a day like this, or when there's 100 traders normally, and there's only 10 left, and the other 90 are gone early. They just the other 10 just throw the baby out with the bathwater, so to speak. So that's why you see some volatility.
You can't sell if there's nobody on the other side.
Yeah. So I mean, it's been a relatively calm, as you can see here. Since about the last couple of weeks, we've been seeing this kind of stuck in this range here. Like I said, we had a good positive run from March 28th up until this last couple of days. We ran from 100.48 to 101.33, so almost a whole point in this this pricing. So we gave some back some today, but there's support right at the 100. Barry said there's 100 support at 100.77, and you can see right here that support level. We got the CPI numbers coming out next week, so it's going to be the numbers. It seems like the market's just digesting stuff a lot better the last month or two than it was 6 or 7 months ago. I mean, it just seemed like 6 or 7 months ago, you open up you open up your computer and it looks like, just the market just had diarrhea. It's just like, oh my God. It's just like, you got
we have a coffee mug for that. Great diarrhea. So we had a comment here, a couple people. So Mark says 2008's coming, says it's all about FOMO. Shoot me some numbers, Mark. What are you seeing that says that this is going to turn around and crash? I'm not arguing with you. I'm just saying you got to show me something. And Jimmy, you're saying 2008, it's going to crash again. Actually, Mark said 2008 is coming. 2008, people had to hand their houses back to the bank. Their payments changed. The interest rates went way up. They were all holding adjustable rate mortgages, more homes than they should have owned. They didn't even qualify for them, so they had to hand them back. Rates went up. Did you see anybody rates went up from 3% to 7% in a matter of 6 weeks? Who handed their house back to the bank?
Yeah.
Nobody.
But he said it was just a joke, so I don't know if maybe
no, Mark, I'm taking you totally seriously.
Maybe he's getting your goat this happy Easter. Yeah.
So I love jokes. If you're going to tune into this show, we have to have a sense of humor. So, but
you get riled up quickly, don't you?
I do sometimes. Like Mark says, I lived through that time. So did I. But fortunately, I got rid of my house in 2006, so I didn't lose my shirt there. I just couldn't make any sense of it. And but I think, to Mark's point here, it's don't say sorry, for crying out loud. Let's have some fun. There's a lot of people out there that will just tell me, it's 2008's coming, and then that's the end of the conversation. They're done. They're like, oh, it happened once, it'll happen again. It happens every 70 years. You're absolutely right.
Yeah.
But I think, and I'm now, having said that, I just read you guys several different big firms that are revising their projections, and they're all over the map. So,
what though? I mean, do you really think that down 2% or down 4% or up 3%? I mean, that's not really
national basis. Who cares?
Huh?
I said on a national basis, who cares?
Yeah, down 2%, up 3%. I mean, 4%. I mean, 4% out of half. It's $20,000. But now if you're talking, if they were saying, if one firm came out and said, we see the market down 40 to 50%. Obviously, I'd like to see their analysis why. But
I remember Robert Schiller saying we were going to decline by 43% in 2006. Yeah. He was standing on the soapbox, but nobody knew who he was. Nobody paid attention, and we went down 48.
Yeah, well, he was right once in 70 years. That's good. Yeah. Good for him.
But he saw how they were bundling the products, and he
saw everything.
So that was
I
right.
mean, and you know what? And honestly, I saw it. Believe it or not, I saw it. I was talking to my we were golfing in '07, '06. I mean, '07. I saw that one day. I talked about how I tried calling this one lender. I called over 30 lenders to try to place this one deal. But me and my buddy were golfing in July, August in 2007, and he worked for accredited home lenders. He said it was a $48 stock at the time. He says within the next year it's going to be worthless, and it was worthless. And he said, he goes, we scratch our heads like, man, there's something going on that's really scary. Yeah, everybody can kind of feel it in the industry, but you just didn't. Obviously there was a handful of people that really knew what was going on, and that's why I discredit a lot of these so-called experts, because if all these experts were experts back in '08, '09, they should have saw this coming. Does that make sense? If they're experts,
Yeah.
there was very few experts really out there. So you can call yourself an expert, but that's why I think you and I in Chandler, Arizona, can be just as good with the data and the information than these Goldman Sachs guys.
Well, you're the only one that got on TV. I put the link in the description below. Pat was interviewed by, what was that called? Home Show or something? Or
Home Hunter. Yeah, Home Hunter.
Home Hunter. So,
yep. Anyway.
Yeah, wow, you're famous. So I don't know what their viewership is, but you were there. So, and hey, everybody, got a deal going here. We're going to celebrate 1 million views. And so all you have to do is sign up for my newsletter. We'll enter you into the drawing so you can win one of these fabulous notebooks and possibly the prized and yet coveted short in demand price mortgage hats.
Well, actually, no, I'm actually a price mortgage jacket.
Oh, you're going to pony up
I'll give out a jacket. Yeah, I'll give out a jacket. So I'll preview it next week. So
Sean says the Arizona market's almost at 7% rates and people still buying. What's going to happen when those come down? Well, they're coming down now. I mean, you quoted a rate like 5% yesterday, didn't you, Pat? So
4.875 on FHA. It was a buy down. It was some of a buy down, but we were looking at 5.5. I got to
clarify. This is 1 million views, not 1 million subscribers. I wish I had that, but I don't yet. But I will. I'll be 90.
No, I think people say what's going to happen when those rates come down. I mean, we saw it. I'm just going to make this is what I see is every time it comes down. I mean, people are kind of settled into the 6-7% range, and they're still moving along at the high sixes. Yeah, obviously, we're now at 6 3/8 range. Like you said, FHA's mid fives. You can buy down into low fives, high fours, and I believe people are saying, well, if I finance at 7%, people say, oh, I could refinance a year down the road, but what if values fall? If rates do come down, I think it's just going to keep the demand plugging along.
Well, we saw what happened when they came down to 5.5. What was it, in August?
Yeah, August.
Sales went up. Lovely to see you. Says, explain the buy down.
There's a two. I mean, real quickly, there's a 2-1. There's a 3-2-1 buy down. There's a 2-1 buy down. There's a 1-year buy down. Basically, the seller pays for a 2-1 buy down on a 400. Let's say it was like this example is $365,000 loan. Basically, it was going to be about, I think it was about $8,000 if I'm not mistaken. It was I have the numbers, but you take the seller contributes as a seller concession, and you subsidize it's put in escrow, and for the next 2 years, your monthly payment, the difference between what you qualify at, say 5.5, it's a 2-1 buy down. If you get qualified at 2.5 or 5.5, your starting rate would be 3.5 the first year, 4.5 the second year, and 5.5 that after that. But for the next 2 years, your monthly payment is subsidized through that escrow payment. If it's $8,000 and you refinance after the first year and you've got, say, $4,000 left, that $4,000 goes into actually reducing your principal. So it's actually a pretty smart little thing if you can get a seller concession. It just starts out your payment.
Sellers to pay for it. It's not a bad thing to have.
Yeah. And in this case, I mean, on $365,000 purchase, I think the first year it was going to reduce the monthly payment by $421 a month. So if you think rates are going to come down, which I really was not a big fan of it at first because I thought it was too gimmicky. But I started looking into it, and I proved my I started doing some research. I'm like, this is actually a pretty darn good idea. And the first year gives you a break because if the rates do come down the year, which they're predicting, you can play the low rate for a while. Then you still got money left over to you have your reduced principal. So, but the seller has to pay for it. So
I think, Stephanie, what we're seeing is that and I'll look up the number here for you. So you're saying price your home anticipating that you're going to do a rate buy down.
a buy down is basically a seller concession.
Yeah, Jimmy, you're right. I don't need to get riled up. You're absolutely right. Though, I mean, every once in a while there's a guy that just kept pounding me, and I didn't mind it. But when he started getting insulting, I just had to say,
you're a little touchy. You're a little touchy.
Well, I'm just drinking water. So here's what happened when rates went down to 5.5 after rates went up here, right?
Yeah.
This is what happened when rates went up. As soon as they went down to 5.5, boom, they went up. Then they raised rates again, and here we are. So now, surprisingly, we're going up here. And so, Stephanie, I'll look up, and I think the thing to look up on this chart for you is seller contributions, and I'll do that off the line here. Running out. Are you seeing any issues with appraisals with purchases? Seller concessions are inflating the sales price.
I will say this. I mean, the last two appraisals I've had, the one appraisal. Let's see, one was done. It was a non-QM, non-qualified mortgage. Basically, it was kind of like a non-conventional loan, kind of like a bank statement loan, or that's outside the conventional guidelines. They call them non-QM, or a conventional loan is a QM qualified mortgage. Basically, it qualifies for Fannie Mae and Freddie Mac guidelines. You hear the word non-QM, that means non-qualified, like bank statement. No, there are some no income, no doc loans out there. I mean, but what I'm seeing, interesting, is the non-QM, the out of the box lenders. For Phoenix, they're checking declining markets, and it's really ticked off some LOs. I mean, in our office, I've had another LO in our office had two of them come back declining markets. So these appraisers are looking back in the old data, and we're like,
we're looking at December and January.
Yeah, I go, it's not declining. The guy's smoking crack. I mean, it's just insane. I mean, and then what happens is then you get an appraisal comes in low. If they have declining markets, if you get them qualified at, say, 80% loan to value, because that's typically a non-QM loan is max, usually 90%, 10% down. It's usually 20% down, 80% loan to value. They'll reduce the loan to value from 80 down to 75. So the client's got to come in with 5% more money.
Yeah.
And it's really jacking up some deals. But we're seeing that on the non-QM. I haven't seen it on the conventional side yet. I mean, I'm sure we will see some of those get,
well, Jackie said she ran into one today, Pat, where it's a VA loan. It came in Tidewater. So they filled out all the forms and everything. She said what they did was these new home developments will have like a teaser home.
Yep.
I'll just make it up, 350,000. But then when you get in there, the homes are actually selling for like 375 to 400. And he used the teaser home as the comp, the base.
Yeah, I mean, he should have considered that if he was, he's going to consider that, but then, he probably should have put that in. That's not my wheelhouse. I mean, I know, they go to apprentice, people don't realize appraisers spend years getting their license.
Yeah. And
they got to be like an apprenticeship for like 2,000 hours or 3,000 hours is some ridiculous. I think they've reduced it, but you can almost become a brain surgeon before you become an appraiser.
Yeah. I've seen what they have to go through, and it's insane. Going back, Stephanie here, we're at 48.3% of homes are contributing to closing costs with an average of $9,000. And then we have Mark says, what thoughts on Mesa? You want my restaurant reviews or let me look.
We're just Mr. Jokester today, aren't we?
Well, it's the markets are closed. We got nothing else to do. So let's see. I'm going to try and find. Um, I'm going to try and pull up by city here and see what I can come up with. So talk amongst yourselves.
Yeah.
So analysis by city. Let's see. We got dollar
Well,
volume,
while
inventory.
you're
Let me
doing
look at let me for a second.
while you're
And
doing that, let me comment on seller concessions. People have found out that by giving seller concessions of $10,000 versus reducing the price of $10,000 is not going to help your payment by maybe 25 or 30, $35 a month. But if you give a $10,000 seller concession that gives the buyer a 2-1 buy down, like you said, on that $365,000 purchase, that his first year payment was going to be reduced by $421 a month.
wow,
So that's a big difference versus just reducing it from 365 to say 355.
that makes a huge
That's the big
difference.
impact.
So if you get concessions from the seller, apply it towards a rate buy down. You're in better shape. Here's what's going on in Mesa. Their inventory is mirroring everybody else. Days of inventory here says we're at 56.2. That's including under contract, and that seems rather high. But if you look at actually days on market, I think it's only, I mean, a 2.3 month supply.
Mhm.
Mesa is not as brisk as Gilbert and Chandler. I can tell you that. But some areas it's hard to tell the difference. I mean, you get up where the 202 meets like, Power Road, and it's going pretty strong. So
Yeah. Mesa's a quirky town.
yeah, it really depends on where you're at. I mean,
Yeah, it's like any town. Gilbert and Chandler too is the same way, but Mesa has always had kind of that, for lack of a better term. I hope I don't hurt anybody's feelings, but redhead stepchild, um, kind of label to a certain degree. Wouldn't you
yeah.
say?
Well, yeah, parts of it are, they just wasn't laid out very well.
Yeah,
Um, their downtown was sleepy. They put the light rail in, and now it's getting pretty vibrant. There
I heard
was
the
never.
downtown's getting. It seems like it's regentrified, or it seems like it's
Yeah,
gonna be
I
like.
just kind of zipped through there once. I haven't stopped there yet, but it's and I don't know if the light rail helped them get all this business, but they've put some new restaurants, a couple brew pubs down there, and it's supposed to be getting pretty cool. East Mesa is nice, but Pat is correct. Yes, yeah. Well, that's um, kind of just pockets. You can drive along and go, ooh, and then go down the street and go, oh, I didn't even know this was here. Especially if
Yeah.
you go up areas like, let's say you want to go up Greenway, and then get past
Well, the
uh,
orange groves up there, or they got some beautiful homes in the orange
the
groves
orange
there.
groves. Yeah, past Brown. So
Yeah,
hello,
McAllips.
YouTube. Casa Grande, Arizona City, in trouble with elusive job cuts and financial troubles. I think so, Tyler. I'm I just call me old dude, but I just don't see a big booming future in large electric semis. I don't. I don't see it sticking. Um, I mean, how
I
far can they drive? I just don't see that, and I don't think your average trucker can afford them. So I think Lucid's going to be in trouble, but they're going to have to continue to get support from the federal government with tax incentives and stuff. But you know, who knows? I just don't see it happening. Do you, Pat?
No, I don't. I mean, I'm not a big fan of it, but I think Casa Grande and Arizona. I mean, I think there are some other things popping up, warehousing and stuff like that, because the connection between Tucson and Phoenix. I mean, that's the I-10. They're doing some stuff down there, so it's not a. I think from a real estate standpoint, it's going to hold its own. I mean, you'll have something move in. I don't. I know the Lucid.
It's not going to hurt the city, so something
Yeah,
will happen. So
yeah.
we got a real estate question here. Do you think EXP would be a good realty brokerage for new agents? Depends on what you're looking for. I mean, for me, it works great. We don't have offices; we work from home, but the resources that we have with EXP, including EXP World, is pretty cool. You've got all the resources and training you need. I will say, if you're a brand new agent, get on a team first so that you can get help. And now you'll have a bigger split. You're going to have to share, your commission with another agent that's running a team, but they take those splits and then they pay for everything. They're going to buy your open house signs. They're going to pay for your marketing. They're going to pay to get you some leads. So kind of look around a lot of different brokerages and see who's got some of the best teams out there, because when you first get in, I mean, I wish I hadn't gone on alone my first year. I should have got on a team, but I didn't even know what a team meant. And that's back in 2012. So it's much easier.
You didn't know me either. You didn't know me. You don't. I gave you direction also.
Yeah, you weren't around to help me at all, so I couldn't do it. And now that I do know you,
you regret it.
Yeah, I'm highly medicated most of the time. So, but well, look, Pat, I'm gonna let everybody go here and have a good weekend. Don't forget.
Hey, let me just. I just real quickly. I just want to comment something I forgot to say on this jobs report numbers. Barry said it was kind of interesting. He was talking about the. And I'll just leave. I know I'm going to go back into it. He said 72,000 of the gains were from leisure and hospitality, and that's been obviously a huge gain. Where the job gains have come from. But this is interesting. He goes, the average hourly earnings were up 0.3 in March, which was in line with estimates from last year. The hourly earnings were up 4.2, which is a decline from 4.6. He goes, average weekly hours declined by 0.1 to 34.4 hours, which is the lowest amount of hours worked since 2019 when not including COVID. I mean, it says that means that on average, out of 161 million workers in the U.S., their hours were reduced by 0.1 hours. Doesn't sound like a big deal, right?
Yeah.
So he goes, and so instead of reducing headcount, it appears companies cut worker hours. But if you calculate how many jobs that would be equivalent to, it would be like losing 468,000 jobs.
Wow. I never looked at it like that.
Yeah. So, he cuts through the numbers pretty drastically. So that's why I follow the guy. So anyway, just want to leave you on that exciting job report information.
Yeah, you can dissect numbers till the cows come home. So
yeah.
All right, everybody, have a super weekend. Happy Easter, and Pat, behave.
Yep, I will. Take care, everybody.
All right. See you guys.
Bye.